Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. We'll start off today looking at the US dollar index, as it seems to be playing a very important role in the price action of the commodities these days. Last week we looked at the market, and the US dollar hit up against the 270-degree mark near 96.81, and upon hitting this area, the market was able to bounce, and it made a small bounce coming up to the 180-degree mark of 97.80. Upon hitting 97.80, we saw a very small pullback in the market, and the market has since resumed back down to weakness. In doing so, it's helped to bolster the commodities a bit, especially corn and wheat, that had fallen pretty strong yesterday and has now been able to recover a bit. In particular, there's been some competition on the part of the Brazilian real, and because the Brazilian currency has been plummeting, it's made for additional competition with the US commodities, putting pressure on corn and soybean domestically. The dollar has been posting sequential lower highs, and in doing so, the market looks like it is poised to continue lower. It is sitting up against volatility-based support right now and may find some short-term support, but the pullback that we see here is perhaps the support that has already taken place, and in doing so, the market then is poised to potentially move down a little bit lower. July corn has struggled to just take off after having made a significant low in late April, but we do notice here that the market continues to make sequential higher lows, although its death knell has been right now resistance at the 380 mark, and it has yet to break beyond that barrier. We saw a nice little run intraday today, but the market has since pulled back some and is trading about in the middle of the trading range. It is significantly higher now from where it did close yesterday. We also are hitting up against one of our natural trend lines. As you can see, the market has now made its way up right into this level here, and we're also sitting at a potential turn point opportunity. In doing so, the market could very well find some energy near this area here, which would allow it to potentially propel its way up and finally make a breakthrough beyond this 380 mark. If it is in fact able to close above this 380 mark this week, preferably 375 or higher, we feel much better about the market being able to touch 390 to 400 before coming off the board. The importance of the 375 mark can be seen here, as it is synonymous with the 360-degree factor in this actual market itself. And as the market continues to test this area just beyond the 375, we do have major resistance potentially overhead coming in at volatility-based resistance near the 385 to 390 mark. So if this market again is able to close above the 375 to 380 mark over the next 2 days, we anticipate that the market should make a good run up to about 390, possibly as high as 400. And once it gets to that zone or that area, look for some resistance. We see the exact same pattern materializing here in the December contract with sequential higher lows. And now we have our fourth higher low. When markets make consecutive higher lows in this fashion, that is a recipe for potential strength. So once again, if this market's able to make its way beyond resistance, which has been sitting at about 395, if this market's able to close above 395 this week, we feel comfortable that we should see a very good or reasonably strong run up to about 405 to 410. The volatility bands for this contract actually are beginning to shift upward, and you can see the momentum here actually starting to turn up after having been sideways for quite some time. And also overhead, we can see volatility-based resistance bands also making a shift to the upside. So initially, we can see that we have resistance somewhere in the neighborhood of 400 to 405, but since the bands are making a shift up, it is probable that the market then can move up to the next area or to the next band, at which point the significant resistance would live somewhere in the neighborhood of about 410 or so. The big drop in soybean on May 18 was perhaps a foreshadowing of what was to come. The market had made its way up and became overbought in conjunction with the market hitting up against our one by one downside red angle here. In fact, the market came back and tested that one by one angle one more time before it made this huge drop here, and in fact gave us a 2-day pullback before again dropping back down, and lo and behold, the spot at which it sits right now is right up against a one by one upside angle. This drop coincided with the market being overbought, and we saw a very precipitous drop since then. The market right now then perhaps is looking at a potential pause, and we do have a timeline coming in over the next couple of days around June 3rd, June 2nd to June 3rd, where the market can potentially turn its way back up again. In doing so, we would be looking for a small bounce perhaps because this market is now looking pretty weak, but it may find some resistance up against 942 to 943 or so. And so this market is significantly weaker right now. And as we look at the chart, it's clear that soybean now is broken with managed money taking on even bigger short side positions. Some of the competition we are receiving from Brazil is also hurting us. So for now, it looks like the summer rally that we've been looking for is improbable. And for now, we're simply looking for minor pullbacks to potentially sell into as the market looks to continue in weakness for at least the next month. The drop in the soybean contract has been significant. So for now, it's due for a potential pause. And that pause will probably land somewhere in the neighborhood of 894 to 905. Upon reaching this pause area, the market will potentially consolidate for 5 to 8 trading days. We could see a bounce that rises to the area of 920, possibly as high as 940 or so. From there, we would not anticipate much strength, but instead for small pullbacks. But we'll continue to watch and monitor what the market looks like over the next 3 to 4 weeks. But for now, upside potential or summer rally does look very improbable. The November contract looks essentially the same. We have support coming in at 1 standard deviation below the point of control at 916 3/4. The point of control lives at 963. So at 963, well above where the market is here, was the key breaking point. Upon breaking this area here for this final time, the market saw the big drop. We got a small pullback coming into our time factor. And upon moving into that time factor, the next seller's bar, the market was then able to precipitously fall from there. We're sitting at a market now that is oversold. So again, a potential small bounce, even if it were to move lower over the next day or two, is due. So at the very least, this market should consolidate or at least have a pause to this big downdraft that we've been seeing. Potential support may land somewhere in the neighborhood of 908 to 912 for this contract, at which point we would be looking at overhead resistance coming in at either 919 or somewhere in the neighborhood of 934. After a weather-related event, wheat has been struggling to find itself. We saw the weather-related advance that it made, and once everything kind of calmed down, the market came back down and came back to essentially where it had taken off from. Since then, it's been moving quite sideways and continues to stay range-bound very close to our Fibonacci levels. Right now, overhead at about 441 is going to be the key breakout point overhead for this contract. And in the event that it breaks down below 422, we anticipate continued lower prices. As long as it stays between that 441 and 422 area, we anticipate continued sideways consolidation. Upon breaking either side of those levels, though, this is where we anticipate some follow-through in either direction. And until the market's clearly able to make its way through either of those areas, look for the market to simply be range-bound. Our cycles did show the potential for the market to rally and move higher, but again, we needed to close above that 441 mark. Alternatively, our market correlations are suggesting that the market should be moving lower, and that looks to be the motion that we're seeing right now. The market has found weakness, is making a few lower highs after having made a nice reasonable bounce. And so from here, especially if we get that close below 422 this week, look for the market to fall and look for the next areas of potential support to fall somewhere in the neighborhood of about 400. The key operating levels for the December contract would be 477 overhead and 456 below. These are going to be the two key areas where this market needs to break either side, at which point we anticipate some very good follow-through on either side of the market. Until it does that, look for continued sideways consolidation, just as we saw with the July contract. December cotton sits at the cusp of a very critical time zone. As you can see from our chart here, each time one of our vertical lines occurred, the market actually started to trend in a strong fashion. Whether the market started to trend up very strong from April 25th to the nice down move that we saw after March 20th, to the nice downdraft that we saw after April 26th, and now we sit at one more turning opportunity near May 28th. Question now is whether or not the market's going to potentially turn up or turn down from here. We sit at a critical zone, and the previous low here that sits at 72.20 would be a potential sell opportunity for the market to run down in the event that it closes below this area. On the flip side, if the market's able to close above previous high and give us a buyer's bar, then the potential for a move to the upside also sits at the forefront of a potential leg to the upside. Part of what makes this decision a little bit difficult is the fact that we are sitting at a lower double top. The market did again make a significant top near March 20th, but from there we saw a lower double top, which often signals that the market looks to make a nice move to the downside, which it has done. Now that the down move has already occurred, part of what we would be looking for then is to whether or not there would be continued weakness, or if our key support is going to hold, at which point the market can then make a potential run to our initial targets that we're looking at. The bias would be for a run to the downside though, especially if that 72.20 mark is hit. So for now, what we want to do is simply wait to see what the market tells us and respond appropriately. We are currently sitting at a position that is a bit oversold, but we'd like to see the market really be significantly cleaner from here instead. In the event that the market does break down, we would then be looking at a potential run that goes probably no lower than about 70.67 or so. In the event that the market does make a breakdown to this area and then starts to turn back up, we do like the market here for a move to the upside. Again, we're simply going to wait to see what the market communicates to us and respond to the chart appropriately. In closing, we'll take a look at the crude oil contract. Here we can see how the September contract came up to our target of 52, as we had been talking about for a number of weeks. The market also did come into our timeline of May 25th. In doing so, the market hit up, time and price did come together, and in conjunction with the market being overbought, we saw a very nice move to the downside. The initial drop did come in at the Fibonacci retracement level of 61.8. We saw a one-bar pullback come in, and the market has since resumed its movement to the downside. From here, we anticipate the market will probably retest previous lows near that 44.76 area, with a target somewhere in the neighborhood of about 44 near our 90-degree mark. We'll continue to monitor crude oil from here. As we can see here, the movement that we'd been looking for with our targets have come in very nicely. So from here, we'd be looking at our next potential turn opportunities to come in near our vertical time zones. Thank you so much for joining us for our weekly market update, and look forward to touching base with you again next week.